Good afternoon, everyone, or good morning to folks on the West Coast. Thank you for joining us today. My name is Jordan Sokloff, and I'm one of the wealth advisors here at Farther. Today, I'm joined by fellow wealth advisor and colleague Christian Pierce. We appreciate you joining for today's session as we cover the key items related to tax planning for travelers' retirement. As we begin our discussion, I want to ensure that everyone understands that although today's information pertains specifically to the Travelers Benefit Program, we are not affiliated with, endorsed by, or sponsored by Travelers Company. We are a separate firm that specializes in financial planning for Travelers employees. Our services are provided through Fidelity's platform. We help manage retirement assets that come from the pension, the 401k, or other various accounts, but we are not a part of Travelers or Fidelity. Now, on to the next slide. What separates us at Farther apart from most other financial advisors is that when we provide help on the benefits and the planning, it should feel like you're talking to someone internal at your company. Acting in a fiduciary manner means that anything Christian and I tell you has to always be seen in your best interest. We're not allowed to take either the company or our own interest first. You, as the end client, always have to be priority number one. Unlike most other advisors, we specifically cater to Travelers employees. So we'll be very familiar with all of your internal rules, calculations, and various aspects of your benefits plan. We give guidance on all aspects of your financial life. Our services include comprehensive financial support. So not only do we do investment management, but we do financial planning, tax planning, estate planning, and of course the benefits planning at Travelers, which we'll go over today. Now on the next slide, we'll jump into a brief overview of our discussion today. We'll focus on the main areas of tax planning for a Travelers employee, including traditional versus Roth 401k, types of 401k contributions in general, after-tax rollovers or conversions, and of course, the recently passed One Big Beautiful Bill Act. We'll then wrap that all up with a Q&A at the end of today's conversation, so please feel free in the chat box throughout today's session to go ahead and submit any questions that you might have. We will cover them at the conclusion of the presentation. Now, to get us started on today's presentation, I'd like to turn it over to my colleague Christian Pierce to discuss the U.S. tax system and timing. Over to you, Christian.
Right. Thank you, Jordan. And again, welcome everyone, and thanks for joining us here today. Before we dive in, I'll share just a little bit of background as to, why you're here, why we reached out, and really how you got invited. As Jordan mentioned, I work with a lot of folks over at the company, and Travelers for me is a little bit special, right? Holds a special place here in my heart. I have family who work at the company, friends over time who work for the company as well, and current clients. Being originating from Bristol, Connecticut, Travelers is pretty much right there in my backyard. And I'm a big fan of golf. So for the last 10 years or so, I've always been attending the Travelers Championship that they hold there in June. So with that, it's certainly something that I care a little bit more about. And it's important for me to help those in my community and that are close to me in life to really understand what's available through them to the company and how they can get the most out of what's being offered. So as Jordan mentioned, we'll start, pretty high level, just sharing a little bit around what the U.S. federal tax system looks like, right? So this stage or this slide here is really going to set the stage for retirement and specifically tax planning in that regard. For those who don't know, our federal tax system is what we call progressive, right? And that means simply the more that you make, the more that they're going to take away from you. Right. And everyone pays taxes. Nobody likes Uncle Sam. So one of the best things that you can do from a planning perspective is really find ways that you can minimize your tax liability. But that also starts with understanding where you are today and potentially where you might be in the future. While you're working, right, your income is really going to change over time. That could be through bonuses, raises, and for some of those at the company who get things like RSUs, that could also come from stock vesting. right? So again, it's important to really coordinate when and how you're going to realize your income so you can understand where you'll fall within the tax brackets and how that's directly going to impact you. Now, as you go through your career and life at the company, you'll ultimately come on the pinnacle, which is going to be your retirement. And once you hit retirement, your income is typically going to be driven from a few different sources, right? Namely, things like 401k or IRA withdrawals. There's also going to be pension income that's going to be coming to you. And then down the road, things like Social Security. So the main goal and one of the most important things you want to understand when looking and knowing about the tax brackets here is again knowing where you are today and where you could potentially be in the future and allows you to be a little bit more proactive within your planning and make decisions that are going to be in your benefit so you're not being pushed into higher tax brackets down the road when you're starting to pull money out of these accounts to maintain your lifestyle or just enjoy living in general. Now, for some of those, while you're working, and if you anticipate that retirement is going to be in the next few years, if you think that your income could potentially be going up, right, from things like bonuses and other sources of income, there's an opportunity for you to leverage these lower income years and potentially convert some of those dollars into what we call Roth. And we'll go through that here in this presentation as we walk through some of these things so you can understand the differences, what might make sense for you, and how you can go ahead and leverage some of these opportunities that'll be there for yourself. Now, one of the first questions that we typically get from a lot of folks is, I've been saving this money in my 401k. I've been at this company for X amount of years. When can I actually access my retirement funds? Now, generally speaking, withdrawals before the age of 59 and a half are going to incur a 10% early withdrawal penalty. But again, with every rule, there's always going to be some exceptions. So as you can see there on the left-hand side, there's a few of those, and it's not an exhaustive list, but really just highlights some of the ways that you can potentially avoid this 10% early withdrawal penalty based upon some of the life events that may be occurring for you, right? Things like disability, paying for higher education, first home purchases, right? Just to name a few. So really understanding and managing when you're going to be pulling money from these accounts is really going to be driven on your age, right? And again, that 59 and a half is when you can go ahead and get rid of that 10% penalty for getting access to your funds. Now, as I shared, right, every rule typically does have its exception. And here are two that are not commonly known, but can be very powerful if it comes in handy for you. And the first one is going to be post 55 or the rule of 55. Now, this applies specifically and only to 401ks. And in this situation, to utilize this rule, if you were going to separate from service and leave travelers at the age of 55 or later, you have the ability to withdraw directly from your 401k plan without penalty. This would be ideal for someone who, let's say, wants to retire early, but they may not have hit that 59 and a half mark, or maybe some of those who are looking to bridge some of the years with income before they become eligible for things like Medicare and Social Security. It can be a very powerful tool for you, but again, it's very specific to 401ks only. The second is going to be what we call 72T. And this rule, opposite of 401ks, is going to be specific to IRA accounts, right? The main caveat between this with the 72T is what we call substantial equal periodic payments. This rule itself forces you to commit to taking consistent withdrawals from your account for 5 years or until 59 and a half, whichever of those two comes later. So to give you an example of what that looks like, let's say you're 57, you want to leave travelers and take advantage of 72T. In this example, we'll say that you have about $50,000 in your IRA account. You would need to withdraw $10,000 per year for the next 5 years or until you reach 59 and a half, right? In this case, because you're 57, you would actually have to take those withdrawals out until age 62 so you can you can actually satisfy that 5 year rule, even though it brings you beyond the 59 and a half. So again, whichever one of those two is later is the one that you're going to have to stick with. So the idea here is to really understand what options and flexibility that you have. Both of these do create some sense of flexibility for you, especially those, as I mentioned, who are looking to retire early or may not be socially eligible or may not be fully eligible for things like Social Security or Medicaid for themselves. Now, This here is really going to highlight some of the differences that you have available to you within pre-tax and post-tax options. Traditional IRAs, right, in fundamentally speaking, they're going to give you the tax deduction today, but all of the distributions and withdrawals that you take down the road are going to be taxable. On the flip side of that, Roth IRAs let you pay taxes now, but all of the growth and withdrawals down the road are going to be tax-free. So to give you somewhat of an example there, right? Let's say you go to the casino with $10. The casino itself is actually going to act like Uncle Sam, and they're going to impose a transaction fee to convert your money into chips. The more that they convert, the higher that fee is going to be. Very similar to our tax system. The more that you make, the more you pay in taxes. But the difference here is they let you choose when and how you're going to do it. You can either pay the taxes now before you walk in the door, or you can pay taxes upon the exit. Applying the pre-tax situation, you would be able to hit that casino floor with all $10 in hand. Now, let's say you grow that $10, you're doing well, you win some money, and you now have 20 and you're ready to cash out. Well, because you've made more money, the casino is going to charge you a higher fee. Earn more, you pay higher taxes. And that's where they're going to hit you with that pre-tax situation, right? So in there, instead of leaving with that $20, you're going to pay a fee on the way out. So let's say you leave the door with $17.50 in your pocket. Looking at this from a Roth perspective, you would actually pay the casino upfront to convert your money into those chips. So you walk in the door, they convert it over, and you hit the casino floor with, let's call it $7.50 because you paid that fee. Now, similarly, you win some money, and that grows to that same $20. The power of the Roth is going to be in your benefit here because you've already paid the piper. So you're able to leave and walk out of that casino door with all $20 in your pocket because, again, you've already paid those fees or taxes up front. That's really the most powerful difference between the two. And it really comes down to understanding where you are today and what you're trying to achieve from that perspective, and also how the taxes are going to be applied and imposed on you. Now, which option might be best for you? Again, all depends upon your specific situation. And those are things that we really help guide a lot of clients through and help them understand, where am I today? Where will I be in the future? And what makes the most sense for me? Should I be doing pre-tax? Should I be doing Roth? Or should I be doing a little bit of both? If you have any questions like that, feel free to throw them in the chat or schedule some additional time. We're more than happy to run complimentary reviews for a lot of folks and really help you understand what's available there. Now, in that same breath, right, we think about what Travelers allows us to do with the contributions we make to our 401k. Again, you have the option to do pre-tax or you can do Roth. The pre-tax option, again, you're going to make that contribution from your account into the 401k without paying taxes. The money's going to grow tax deferred. And when you go ahead and pull it out of the back end, that's when Uncle Sam's going to knock on the door and hit you with that tax bill. On the opposite end, you can also make what they call Roth K contributions into the Traveler's 401k plan. Here, you're going to pay taxes once you make that contribution, but the money in that account is going to grow tax-free. And when you go ahead and pull it out in the back end, you get that money tax-free as well. The difference here and where you can really start to get creative is utilizing potentially both of these options for yourself. And what that's going to do is create what we call tax diversification and gives you a pre-tax bucket and a Roth bucket. And the power of that down the road is flexibility and the option to choose, right? Life always has its ups and downs and things come out of left field at all times and emergencies happen, right? And at times we may need to access funds before we actually want to. Being able to choose whether you're going to pull that from a Roth account or a pre-tax account and what the tax implications will be for yourself is going to be very powerful in, again, giving you the options down the road to be able to make that decision for yourself. And again, in addition to, the two contribution types there, Travelers is also pretty generous within what they give you. And there is an employer match, right? From our side of the table, that's one of the only times where we say you're going to get some free money, so take advantage of it. Travelers is actually going to match you dollar for dollar 100% up to that 6%. So go ahead and take advantage of that. And within that, you'll be able to have added money into that 401k, which is going to grow for you either pre-tax or within that Roth account. The benefit here for you guys there at Travelers is the fact that you're able to combine the pre-tax and the Roth, get the employer match, and actually be able to take advantage of maximizing your 401k. Now, when we talk to a lot of folks, they typically come to us and say, yes, I'm maxing out my 401k. I just put in the 6% to get the company match. Well, that is great. However, that's not traditionally maxing out your 401k. The IRS has limits to which they say this is the most amount of money that you can put into a 401k in any given year. For the year of 2025, that number is 77,500. Or there's going to be now with the tax bills, what we call catch-up contributions. So if you're over a specific age, they actually let you put more money into these accounts in what they call the catch-up. And that's going to be $81,250 for the super catch-up. So within understanding this, you want to know what you're eligible for. If you should be doing pre-tax or Roth, should I be doing the catch-up contributions? Am I even eligible for them? And does it make sense for me? These are all questions that will help you be able to answer, and some of the things that we work very closely with folks for, especially those who are thinking about retiring in the near future. How can you maximize what you're getting today from Travelers and set yourself up for a little bit more success down the road? And again, give yourself the option to choose. Now, we know that contributions are going to be made into the account. We select what percentage we're going to do, whether that be 3, 6, or 5. It doesn't matter. You make your contributions, you select pre-tax or Roth, and you get your employer match. The final part of that is actually putting that money to work, right, and selecting the investments. Travelers traditionally gives you 3 options. One is going to be the core target date funds. You'll see that within the investment menu. They usually have a set date in the future, which is going to coincide in a date that you would choose to retire. So for example, if you wanted to retire 5 years from now, you could select the target date 2030. And that is when that's how your investment selection would be matched up within that account. They also give you a powerful option to select what's called brokerage link. Now, the brokerage link is really where we help a lot of folks over at the company take a little bit more control of their 401k, provide a little bit more customization, and help them grow their money the way that they want prior to reaching retirement. And I'll go into a little bit more detail on that here for you as well. So the brokerage link, as I mentioned, is a separate account that stays within your Travelers 401k. And it's a major advantage for Travelers employees, as I said, who really just want more control over their retirement savings and how they're growing their money. One of the biggest benefits of the brokerage link option in that 401k is it opens the door and gives you a more expanded investment menu. You're allowed to access thousands of things like mutual funds, ETFs, and all of the like. And typically, this is going to come at lower expenses to you as the investor. The other benefit for you is broader diversification and tax efficiency, right? When you think about leaving the company and moving those funds to an IRA, traditionally what's going to happen is they're going to cut a check, sell all of the investments in that account, write a check, and then deposit that into your IRA account. Now, that process can span, days, weeks, and we've seen it take even longer. But the downside there is that you have to sell everything and then hopefully get reinvested. This leaves you open to potentially selling at lows and buying back into the market at highs. Brokerage link option actually helps you supersede all of that because Travelers lets you take those brokerage link investment options that you have and transition those directly into your IRA without having to sell any of those. So it can become very powerful for those who want to maintain consistency within their investments and not have to really worry about potential volatility that's going on within the market and things that they can't control by maintaining their investment strategy along the way. So again, we'll dive a little bit deeper into the brokerage link in some of our, further dated webinars that we have for you guys. But I just wanted to really share what the power of brokerage link can do for you. I know not a lot of people are well versed or even know that this option is available, but it's something again that can be very powerful for you guys over at the company when you're thinking about just having more flexibility and greater control and a lot more customization and personalization as to how you're growing your money yourself. Now, as I mentioned within the brokerage link being, kind of giving you that advantage when you're rolling over some of those assets, once you leave Travelers, you're going to have to make a decision on what you want to do. right? Whether you roll those into a traditional IRA or you roll them into a Roth IRA, that is all going to depend upon your current versus expected future tax situation. Rolling them into a traditional IRA is going to keep that tax deferral, but those future withdrawals, as I said, are going to be taxable to you. The important note here is that contributions are really going to only be deductible as it shows if you don't have a 401k at your current company. So you can make contributions to a standalone IRA outside of your 401k, but there's no additional tax benefit for you there. The Roth IRA, again, requires you paying some taxes now, but all of those future withdrawals are going to be tax-free, right? Money's going to grow tax-free, and then down the road, when you pull it out, there's no taxes that are going to be paid there. The caveat to the Roth IRA is that if you earn too much money, they don't let you contribute to a standalone IRA, right? So that can be a downside for folks who are higher income earners or are just over the IRS threshold of income and aren't allowed to make contributions to that Roth account. To go kind of give you a backdoor around this, Travelers actually gives you an avenue to take advantage of this by allowing you to do with what's called in-plan Roth conversions. So an in-plan Roth conversion is where you take pre-tax dollars that are in that 401k account and convert those into Roth dollars. The benefits and planning considerations here are going to be displayed there for you on the right side. And I'll give you a little bit, I'll walk you through briefly just kind of how that works. So let's say you want to go ahead and take advantage of a pre-tax and in-plan Roth conversion. What you're going to do is convert any eligible balance from the pre-tax side of your accounts and pay the taxes in the year of that conversion. The benefit, again, is that you now have access to a Roth account, and all of that future growth and withdrawals is going to be coming tax-free for you. There's no early withdrawal penalty on Roths, and the key here is being prepared to pay that tax bill with outside funds. Travelers doesn't let you pay the tax bill with any of the funds that are in those accounts. So when you're thinking about potentially taking advantage of some of these Roth conversions, one of the key considerations, just making sure that you have some of the funds available because you should be ready to pay a higher tax bill than you normally would in other years. That's to account for the conversion of these funds from pre-tax to Roth. The best benefit here is by gradually doing this over time and maybe not in large chunks, you're able to reduce your future required withdrawals from these accounts. And again, creating more flexibility for yourself to manage your retirement income, be a little bit more strategic around your tax brackets, and maybe even get yourself into a situation where you don't have to worry about what's called RMDs once you come to that time period. Now, RMDs. Those are what's called required minimum distributions. Now, when you hit a certain age, the IRS is going to require you to begin taking distributions from those pre-tax accounts, right? That age limit has actually gone up from 72 and is now 73 years old. Roth accounts are not subject to RMD requirements. So again, those things like conversions and making contributions to Roth is where that becomes powerful because you're not forced to take that money out. RMDs are going to be calculated for you at the age of 73, and it's going to be based upon your account balance at that time and your future life expectancy. The challenge here with RMDs is that they can significantly increase your taxable income, potentially in years where you don't want or need that money. All right. In addition to that, what they're doing is actually going to affect things like your Medicare premiums and even how your Social Security is going to be taxed at that point in time. If you are subject to RMDs, you want to make sure that you're very timely and proactive about taking those and doing so in the right amounts, because there are hefty penalties for not taking the right amount of RMD or not taking one altogether. The IRS actually imposes up to a 50% limit, or 50%, I'm sorry, 50% penalty of the amount of the RMD that you were supposed to take if it was not taken. So imagine that they say, hey, you have to take $2,000, but because you didn't do it, we're going to charge you a 50% penalty, and you still have to withdraw that money from the account. Now, you can see how over time this can become problematic because you're now paying additional fees and penalties on top of the money that you may or may not need. And when we go back to thinking about the tax brackets, something like this could easily push you into a higher tax bracket. And that's the last thing that we're really looking to do. So it's because of this why things like planning timing withdrawals, and managing Roth conversions and balances before you reach that RMD age are going to be extremely important and crucial for managing your long-term tax impact. Now, some tax changes that are coming due or down the pipe here with kind of the changes that we're seeing in the law. All right. So historically speaking, all right, taxes have always gone up. But recently, under the new tax law, well, under the current tax law, which is the Tax Cut and Jobs Act, taxes were actually lowered for one of the first times in history. And then the new bill that's coming into play in 2026 did us another favor by actually making those lower tax brackets permanent from now until the year 2028. So basically, what this allows you to do is it extends your window and runway and allows you to take advantage of those Roth conversions at these lower levels for the next 3 to 4 years. In addition to maintaining the lower brackets, there's also introducing something new, which is called the senior deduction. Now, for those folks who are 65 or older, you can now deduct up to $6,000 per year from your tax filing. And if for couples who are filing jointly, this number is 12,000, right? Keep in mind that this is also subject to what we call phased out limits. So the more that you make, the less of that deduction you're going to be able to take. Again, when you think about broader planning and just trying to be strategic, understanding where you are today from a tax perspective and where you could potentially be in the future will help you understand what deductions you might be available to take advantage of and ones that you may be phased out of and may no longer be relevant for yourself. One of the other more important things that comes along with this is going to be the Social Security deduction, right? This one has also been enhanced within the new tax laws, but like the senior deduction as well, has its phase out limits. So you can see at $75,000 of earned income for an individual, that's going to start to lower the deduction you're eligible to take. And then for those married filing jointly, that's $150,000 of earned income in that year. If you go over that number, those deduction levels are also going to be coming down as well. One key consideration that I did want to just share with you here is really around the medical deductions and potentially, looking at utilizing things like HSAs for those who have the high deductible health plan. The medical deductions are starting to come down, so you're no longer going to be taking as high of a number in your deduction for your taxes, but that only increases the need and the importance of things like making contributions for healthcare costs in the future. Right. So planning and timing are going to be key and crucial when you think about things like your overall tax situation, but also the availability of funds down the road. Being able to use an HSA to cover medical bills down the road rather than having to use out-of-pocket cash could be something that's advantageous. And HSAs traditionally allow you to pull that money out tax-free as well when they're going to qualified medical expenses. So some things that you could be doing today are really potentially maximizing or taking advantage of an HSA so you can save yourself a little, so I guess a few bucks down the road when you're thinking about potential future medical expenses and not having to maybe go into an IRA or an old 401k and pull funds out that way, being subjected to any penalties or any taxes that may come along with that. You can maximize the HSA and take advantage of that for yourself. Now, finally, kind of wrapping it all up and putting all of this planning and taxation into a nice, clean withdrawal strategy, that's where it's going to be crucial and important for you guys during retirement. Withdrawals should be sequenced intentionally so you can maintain tax favorability for yourself. Now, for our side of the table, we typically like to coach folks to take their taxable accounts first, then your pre-tax, and then your Roth. What this allows you to do, most importantly, is actually control your taxable income and manage your Medicare thresholds and premiums that are going to be there for yourself, especially how much you're going to be paying. Converting things like pre-tax to Roth during lower income years before you reach the age of 73 can help you avoid those things like RMDs, become a powerful way to minimize your overall lifetime taxes. Rolling Roth 401k contributions that you make through the company into Roth IRA, again, another way to avoid some of those RMDs for yourself. So the message here and really what's most important takeaway is just understanding that tax planning doesn't end at retirement. It's an ongoing thing. And strategic timing and planning is something that allows you to really preserve your wealth a little bit better, take a little bit more control over your income and where your taxation is going to be, and really how you're going to grow your money and enjoy the things that you like to do in life. So I will pause there. That's all the content that we have here for you guys today. Again, this is going to be the first of many webinars that we host here for you guys over at Travelers. But I wanted to just pause and see if we had any questions from anyone in the crowd or anything that we might be able to answer.
Yes, Christian, a question came in through the chat box, hoping you can elaborate on this for the participant. The question is there a best way to decide whether to do after-tax contributions now to your 401k versus doing a Roth conversion of pre-tax amounts already in your 401k?
Sure. So that's actually a pretty good question. And traditionally, what we like to do there is really walk people through their specific scenario. I wouldn't say that one is, off the bat going to be better than the other. It's really all going to depend upon your specific situation. And in this instance, when you're thinking about conversions versus contributions, the amount that we're looking to convert is going to be a direct correlation to the taxes that we're going to have to pay. So that's really where some of that flexibility or the fluctuation is going to happen, is when you look at the dollar amounts that are going to be converted or contributed to the Roth accounts that you're looking at. And that's something, again, we can help you answer. If you're interested in kind of walking through, we'll do a complimentary review. We're happy to for you guys and just look at some of the numbers, give you some guidance and feedback on your specific situation, understanding, again, where you are today, some of the things you'd like to see happen over the next few years, when retirement might be for yourself, and just sharing some of the ideas and strategies you could be taking advantage of to set yourself up for that future success. Any other questions?
That is all from the chat.
Right. Okay. So there on the screen, you will see there's just a few of the questions that we generally get from folks over at the company, right? Should I pay off my home at retirement? How are taxes going to be if I relocate? These are situations and scenarios where we'll specifically run, what we call what ifs and say, if you do this, here's what the outcome would look like. If you do this, here's what the outcome would look like. And then allow you to really make that decision for yourself, but have that be an informed and smart decision that you're going to be making. Now, paying off a home at retirement is certainly one that we get often, and that's all going to depend upon things like your income needs, your interest rate on your current mortgage, if that balance is still outstanding. And one of the big considerations within paying off a home at retirement is going to be coming down to what we consider opportunity costs, right? If you have a low interest rate, what could I be doing with this money if I wasn't going to pay off the balance? Would I be able to grow it in a way that's going to beat what I would effectively be paying on interest in my mortgage? So you want to take that into consideration. And additionally, when you wear that tax hat and look at things through that lens, mortgages actually, from a tax perspective, when you make that payment, allow you to take a mortgage deduction on your taxes, right? If you're going to be itemizing. So taking all of that into context, we could certainly help you walk through some scenarios like that and understand if it makes the most sense for you to pay things off. And then second, we traditionally get a lot of, hey, I'm a snowbird. I'm in St. Paul, Minnesota. I'm in Connecticut, but I want to retire and go somewhere warm. Well, certainly that's, a big topic for a lot of people, and understanding where you're going to be relocating and how that state specific taxation is going to work is key here, right? So to give you an example, Florida itself doesn't have any state taxes. So if you were going to leave Minnesota or Connecticut and go down there to Florida, well, you would then have Social Security, pension, IOA withdrawals, but that's going to directly affect your take home pay because they don't impose any state taxes as to where Minnesota and Connecticut do. So understanding where you're going to be when you're receiving this income has a direct impact on how that taxation is going to happen within that state. And again, we can certainly help you run through some different scenarios and model things out for you to understand if it makes the most sense, and then start to put together a strategy to help you take advantage of everything that's in front of you. So with that, I know we're shortly over time, so I appreciate you all for joining us here today. There will be a recording of this here, so we can share that with you all. And then, like I said earlier, This is going to be the first of many webinars that we host for you guys over at Travelers. Some of the future ones that you can anticipate are specifically around the pension. For those of you who get RSUs and bonuses, that traditionally comes around that February timeframe. So we'll be hosting another one probably late January to shed some light on that. And then again, everyone's got a knock on the door, or everyone gets a knock on the door from Uncle Sam in April. So we'll be doing something around that time period as well, just thinking about preparation and making sure that you've done everything you can before actually filing your taxes and getting the most out of your take home and net pay. So with that, I will stop there, and I want to say thank you again all for joining.